All, let me thank my colleagues, thank our witnesses, those who are in attendance. This morning the committee will come to order, and this morning we meet for a hearing on the turmoil of U.S. credit markets, recent actions regarding government-sponsored entities, investment banks, and other financial institutions. We want to welcome our distinguished witnesses here this morning. We thank the Secretary of the Treasury, Hank Paulson, who's here, the Honorable Ben Bernanke, of course, the Chairman of the Federal Reserve, Christopher Cox, Chairman of the Securities and Exchange Commission, and Jim Lockhart, the Director of the Federal Housing Finance Agency. The way we're going to proceed this morning is I'll make a brief opening statement, turn to my colleague from Alabama, Senator Shelby, the former Chairman of the committee, to make some opening remarks. And given the magnitude of this issue and the seriousness of it, I'm going to ask if my colleagues would like to make any brief opening comments quickly, and then we get to our witnesses. My goal would be that we terminate the hearing sometime around noon if we can. We all recognize the gravity of the situation, the importance of these witnesses to be able to get back and do the work they're doing. So my hope would be that we try and move along here. But again, I want to give each of my colleagues a chance to at least say something at the outset of these remarks. But I beseech you to try and keep them brief. All of your full statements will be included in the record, and any supporting documents you care to include in the record will be there as well. So with that admonition in mind, we'll try and make the opening rounds here about 8 minutes apiece. That way we can at least get a decent responses and opportunity to ask questions. And I'm not going to gavel down tightly, but try to keep it within that framework if we can. With that, let me share some opening thoughts this morning, and then I'll be turning to Senator Shelby. The committee gathers this morning at an extraordinary and perilous moment in our nation's history. The landscape of our nation's economy has been radically reshaped by the United States government over the course of just a few days in a totally ad hoc manner, it would seem. Companies that have formed the foundation of our financial markets are shrinking and disappearing practically overnight. Their insatiable appetite for risk in many cases has permeated all sectors of the financial services industry and has spread beyond our shores. It has felled giants like Bear Stearns and Lehman Brothers, brought others to their knees like Merrill Lynch, AIG, Fannie Mae, and Freddie Mac, prompted the largest, I might point out, thrift failure in our nation's history, the IndyMac Bank, and eliminated the final two independent investment banks, Morgan Stanley and Goldman Sachs. These drastic changes have reverberated far beyond the trading floors and boardrooms of corporate America. Across our great nation, families are gathering around their kitchen tables each night asking how they will weather this storm and how it will affect them very directly. Hundreds of billions of dollars that Americans invested in retirement accounts and mutual funds have evaporated. Homeowners are watching the value of their homes plummet. Foreclosures are forcing 9,800 families from their homes each and every day in our country. Families worry about how they will afford groceries and tax and gasoline. 600,000 Americans have lost their jobs, while millions more have watched their paychecks shrink and their benefits wither away. Perhaps the most dangerous consequence, the one that we don't speak enough about, in my view, of this economic maelstrom is that our collective confidence in our nation's future has been badly shaken, and that needs to be restored. Less than 6 months ago, our banking committee gathered in this very room to listen to the financial leaders of the Bush administration describe what at the time seemed an inconceivable event, the government's $30 billion intervention in the sale of Bear Stearns to J.P. Morgan. Now, after spending hundreds of billions of dollars more to prop up, bail out, and wind down a multitude of institutions, the United States government effectively runs, supports, or outright owns vast swaths of the financial sector. American taxpayers are angry, and they demand to know how we arrived at this moment, and more importantly, right now, how the architects of this economic landscape will put us back on a sound financial footing and restore American confidence and optimism. As I and many members of this committee have argued for the past 17 months since I became chairman of this committee, the root cause of our economic crisis has been the collapse of our housing market, triggered by what Secretary Paulson himself has called bad lending practices. These are practices that no sensible banker should have engaged in, and many did not, I might add. Reckless, careless, and sometimes unscrupulous actors in the mortgage lending industry that allowed loans to be made that they knew hard-working, law-abiding borrowers would not be able to repay. Financial regulators acted much too late and much too timidly. They failed to enforce the laws that Congress passed requiring them to prohibit these bad lending practices. What is tragic and lamentable is that the ensuing calamity was entirely foreseeable and preventable. This was no act of God. It was not like Hurricane It was created by a combustible combination of private greed and public regulatory neglect. And now we must confront the present crisis. Barely 72 hours ago, Secretary Paulson presented a proposal that he believes, and others do as well, is urgently needed to protect our economy. This proposal is stunning and unprecedented in its scope and lack of detail, I might add. It would allow the Secretary of the Treasury to intervene in our economy by purchasing at least $700 billion of toxic assets. It would allow the Secretary to hold on to those assets for years and to pay millions of dollars to hand-picked firms to manage those assets. It would do nothing, in my view, to help a single family save a home, at least not up front. It would do nothing to stop even a single CEO from dumping billions of dollars of toxic assets on the backs of American taxpayers, but at the same time do nothing to stop the very authors of this calamity to walk away with bonuses and golden parachutes worth millions of dollars. And it would allow this Secretary and his successors to act with utter and absolute impunity without review by any agency or a court of law. After reading this proposal, I can only conclude that it is not just our economy that is at risk, but our Constitution as well. Nevertheless, in our efforts to restore financial security to American families and stability to our markets, this Banking Committee has a responsibility to examine this proposal carefully and in a timely manner. In my view, any plan to address this crisis must embody three principles. First, American taxpayers must have some assurance that their hard-earned money is being used correctly and responsibly. Second, we must put in place proper oversight so that the executors of this plan are accountable and their actions are transparent. And finally, we must address the root cause of this crisis by putting an end to the rising number of foreclosures sweeping across our nation. In the longer term, it is clear that our current economic circumstances demand that we rethink, reform, and modernize supervision of the financial services industry. Certain basic principles should form the foundation for reform. We need a leader in the White House who will ensure that regulators are strong cops on the beat and do not turn a blind eye to reckless lending practices. We need to remove incentives for regulators to compete against each other for bank and thrift clients by weakening regulation. We need to ensure that all institutions pose a risk to our financial system and taxpayers are carefully and sensibly supervised. And we need to accept the premise that consumer protection and economic growth are not in conflict with one another, but inexorably linked. If we learn nothing else from this crisis, it is that the failure to protect consumers can cause the collapse of our largest financial institutions, the loss of hundreds of thousands of jobs, and the draining of hundreds of billions of dollars of wealth from hardworking Americans. Today, we're very fortunate to be joined, as I said at the outset, by Treasury Secretary Henry Paulson, Federal Reserve Chairman Ben Bernanke, SEC Chairman Chris Cox, and the Director of the Federal Housing Finance Agency, James Lockhart. Regardless of how some may feel about the decisions these leaders have made and the impact they have had, we all ought to be able to agree that these four individuals are good, talented, knowledgeable, and experienced individuals who I think want to do the very best for our country. And I agree as well that we need to move, and move quickly if we can, but I feel even more strongly that we need to move carefully and prudently and to make sure that what we do is right. I understand speed is important, but I'm far more interested in whether or not we get this right. There is no second act to this. There is no alternative idea out there with resources available if this does not work. So it's critically important that we get it right. And the purpose of this hearing is to discuss whether or not this is the right approach and how we can prove it if we need to. Senator Shelby.
Thank you, Chairman Dodd. This may be the most important hearing that this committee has conducted, at least in the 22 years I've been a member here. Over the last 10 years, trillions of dollars were poured into our mortgage finance markets, often with the encouragement of well-intended government programs. At first, the money backed conventional mortgages with standard down payments and properly verified incomes. Over time, however, the number of home buyers that met conventional loan requirements dwindled rapidly. In order to fuel the upward spiral, mortgage products became more exotic, requiring less of borrowers and involving more risk. Without regard for fiscal prudence and simple economics, bankers, investment bankers, mortgage brokers, realtors, home builders, mortgage bankers, and home buyers created the conditions that helped inflate the housing bubble. At the same time, Wall Street was developing ever more sophisticated financing vehicles to ensure that money continued to flow into the mortgage markets to meet the demand. Mortgages were pooled, packaged, and rated so-called investment grade by the credit rating agencies. They were then sold into a market eager to purchase securities with a wide range of risk and yields. Many purchasers employed massive amounts of leverage, layering risk upon risk in an effort to maximize return. To cover their risk, many of the buyers also bought credit protection from one another, entering into derivatives contracts with nominal values in the hundreds of trillions of dollars. All the while, our financial regulators appeared to be unaware as they sat on the sidelines. As early as July of 2003, here at the Banking Committee, I asked Chairman Greenspan, then Chairman of the Federal Reserve, whether he was concerned about the growing number of loans to borrowers with weak credit histories and the number of homeowners who spent more than 50% of their income on housing. I also asked him if he was concerned whether an economic downturn could lead to increasing delinquencies and foreclosures. Chairman Greenspan, at this very committee, assured us that increasing home prices provided an equity cushion for mortgagors and that lending to such borrowers would pose, quote, a rather small risk to the mortgage market and the economy as a whole. As recently as March of this year, Vice Chairman of the Federal Reserve, Cohn, in testifying for this very committee, assured us that the banking system was, and I'll quote his words, sound overall condition and that losses, quote, should not threaten their viability. Now, we now know that was not the case. Eventually, economic reality caught up with our housing market, and housing prices stalled and then began falling. Many who bought homes with unconventional loans found that they were unable to afford their rising payments. Because home values were dropping, they were unable to refinance, and delinquency rates skyrocketed, as we all know. Once homeowners began defaulting, the value of mortgage-backed securities plummeted. Collateralized debt obligations, or we call them CDOs, that were comprised of the riskiest mortgage-backed securities became worthless. As a result, financial institutions holding securitized assets have suffered enormous losses and have been desperately trying to raise new capital. Of the 5 investment banks regulated at the beginning of the year by the Securities and Exchange Commission under its Consolidated Supervised Entities Program, 2 have failed. 1 was forced to merge with a bank, and the remaining 2 have now left the program to become bank holding companies. The recent demise of our investment banks lies in stark contrast to the vote of confidence we received in the Banking Committee from Chairman Cox in February of this year, when he assured us that the CSE program was up to the task. And I will now quote Chairman Cox. The purpose, according to Chairman Cox's words, the purpose of the CSE program is to monitor for and to act quickly in response to financial or operational weakness in a CSE holding company that might place regulated entities or the broader financial system at risk. The Commission, that is the SEC speaking of, seeks to ensure that the holding company has sufficient standalone liquidity and financial resources to meet its expected cash outflows in a stressed liquidity environment for a period of at least 1 year. That was earlier this year. In late 2007, Mr. Eric Siri, head of market regulation for the Securities and Exchange Commission, described a consolidated supervision program that had, quote, demonstrated its effectiveness during the current credit market difficulties. Nothing can be farther from the truth. He likewise assured us that the SEC's consolidated supervision had achieved, quote, the goal of reducing the likelihood that weakness within the holding company or an unregulated affiliate will place a regulated entity or the broader financial system at risk. Notwithstanding assurances to the contrary, uncertainty about housing prices and the value of mortgage-backed securities have brought our markets to a halt. We're now facing the most serious economic crisis, as Chairman Dodd said, in a generation. So far, the Treasury Department and the Fed's response to the crisis has been a series of ad hoc measures. First came the bailout of Bear Stearns, which we were told was unavoidable. Then came Lehman Brothers, which was allowed to fail. And then just last week, the Fed and Treasury organized a bailout of AIG. I believe the absence of a clear and comprehensive plan for addressing this crisis has injected additional uncertainty into our markets and has undetermined the ability of our markets to tackle this crisis on their own. Unfortunately, the Treasury Department's latest proposal continues, I believe, its ad hoc approach, but on a much grander scale. The plan contemplates the purchase, as we know, of up to $700 billion in troubled, toxic mortgage-related assets from financial institutions that nobody would buy. Treasury expects, but is not required, to purchase most assets through a type of reverse auction process. There are very few details in this legislation. In fact, Treasury officials admit that they will have to figure out the mechanics as they go along. Rather than establishing a comprehensive, workable plan for resolving this crisis, I believe this legislation merely codifies Treasury's ad hoc approach. My hope is that this hearing will give us an opportunity to explore the parameters of the plan and why Secretary Paulson believes it will work. I also hope to hear why the plan does nothing to address the root cause of the crisis, the rising default rate on mortgages. While Wall Street banks get to sell their bad investments to the Treasury Department, homeowners will still be saddled with mortgages that they cannot afford. My record is very clear on taxpayer-funded bailouts. I have long opposed government bailouts for individuals and corporate America alike. As a young congressman, I voted against the loan guarantees for Chrysler, I believe in 79 or 80. However, if the government is going to get into the bailout business, shouldn't we also be focusing our resources on average Americans, the taxpayers, rather than sophisticated and well-compensated Wall Street bankers? The Treasury's plan has little for those outside of the financial industry. It is aimed at rescuing the same financial institutions that created this crisis with the sloppy underwriting and reckless disregard for the risk they were creating, taking, or passing on to others. Wall Street bet that the government would rescue them if they got into trouble. It appears that bet may be the one that pays off. Once again, what troubles me most is that we have been given no credible assurances that this plan will work. We could very well spend $700 billion or $1 trillion and not resolve the crisis. Before I sign off on something of this magnitude, I would want to know that we have exhausted all reasonable alternatives. But I don't believe we can do that in a weekend. Unfortunately, the incredibly accelerated process for considering this bill means that Congress does not have time to determine if there are better alternatives or any alternatives to the Treasury's plan. I'm very concerned that the expressed need to pass something now may prevent us from devising a plan that would actually work. Without question, our markets and financial institutions need serious attention. I do not believe, however, that we can solve this crisis by spending a massive amount of money on bad securities. It is time for this administration and the Congress to do the work of devising, as quickly as possible, a comprehensive and workable plan for resolving this crisis before we waste $700 to $1 billion of taxpayers' money. Thank you, Mr.
Thank you.